For more on this, let's bring in Kevin Warsh, who's former Federal Reserve Governor and Shepherd Family Distinguished Visiting Fellow in Economics at the Hoover Institution. I believe he sneaks in a little professorial work at the Stanford Business School because he has so much time on his hands. Kevin Warsh, Jay Powell chose to fight the CPI and not the banking problem, and then tried to have it both ways, and it didn't work out so well according to today's stock market drop. What's your take on this story?
So, Larry, great to be with you. This is an easy day to pile on Chairman Powell and the Fed. The stock market's down, the dollar's down today as it has been for the month. Today he said that he would raise rates, but yields fell. This is the first time that the bond markets reacted so quickly in the opposite direction that I can remember really since the year 2000. But Jay Powell found himself in this situation because years and years of monetary madness. So after keeping rates at zero when the economy was booming in the year 2021, the Federal Reserve now has raced to the other side of the boat and raised rates, and markets don't like it. So I think they've got a very difficult task here now, Larry. They've got price instability. They have early signs of financial instability, and they have an economy that's weakening right in front of their eyes.
You know, I don't really understand the decision. I know most people wanted them to do what they did, according to market gurus and whatnot. But when you read the FOMC press release, to which you are intimately acquainted, having been a governor for 6 years or so, they're basically saying we're going to tighten more, and they're basically saying credit conditions are going to tighten more. And that's not what people want to hear, because banking conditions are already tightening. Even though you only have a couple of banks on the chopping block, who knows what's going to happen in the future? But the point is, loan standards are being tightened, right? I guarantee you commercial loan issuance is going to go way down. Commercial real estate is a problem. As you well know, the property markets are slumping. And, of course, the bond markets have been a disaster. It's like Kevin, I mean, I don't know if he made the right or wrong decision, but I think he played it wrong, as he usually does in these news conferences. And then you got to ask yourself, why doesn't he want to cooperate with fiscal? If he doesn't deal with the fiscal side, the Fed's never going to have a decent pass at curbing inflation. He got that wrong, too.
So you and I have had this discussion for years, Larry, and you've heard me say that we need economic policy regime change. Mm-hmm. We haven't seen any of it. And I think at core, what happened today is the future is uncertain. Like you, I think the economy is weakening. After these bank bailouts, credit will contract everywhere. And today, I think the Fed made the bet that the banking system problems are contained, nothing to worry about. It's as if that's in the rearview mirror. But after years and years of an everything bubble, I wouldn't take that risk. The other thing that I think that they would have been well advised to do, Larry, today is stop putting out these forecasts. The forecasts have proven to be incredibly wrong for a long time. They don't know the future, neither do you and I. The economy looks to me quite a bit fragile. They've been chasing a ghost all year as if the economy is reaccelerating. The only place I see the economy strengthening this year is in the government data, not with a single CEO with whom I speak. So I think they would have been better to be a bit humbler today rather than betting that price stability is their number one objective and dismissing any idea that the banking problems are behind them.
Yeah, that was my thought going into this meeting, and he flunked that. I mean, he flunked that left and right. Kevin, Janet Yellen de facto says that the FDIC and the Federal Reserve will guarantee all the deposits of the banks, including the uninsured deposits. Now, it just seems to me that that is a very risky statement to make. It undermines market forces. It undermines discipline. It's got moral hazard written all over it. You know, what's your take on what Yellen said?
So I think that's a mistake. Chairman Powell in his press conference today said, and I think I'm quoting, all deposits are safe. Well, the only people that can ensure that all deposits are safe is the United States Congress.
Right.
After the 08-09 financial crisis and Dodd-Frank, they put in a new provision. And the new provision said, if you want to backstop all deposits, that requires a joint resolution of Congress. So Congress is the one who could do it. The regulators can't, certainly can't anymore. And I think it was imprudent for another reason. What the Treasury and the Fed have done in the last several days is create yet another implicit guarantee.
Right.
And when markets are skittish like this, what they like to do is test implicit guarantees. So they will go and look at the next institution, see if they can push those over, and see exactly what the economic authorities do. I think it's unwise for them to do it, to make guarantees they can't support. And what we need is stability, and I thought this would push in the opposite direction.
Yeah, you're absolutely right. They'll test it. You're absolutely right. There is no Fed put. They don't have the authority. I got to go. Kevin Warsh, thanks a million. Appreciate it.